Okay, so good morning, everyone. Welcome to today's macro snapshot. We are Thursday, December the 7th, the anniversary of Pearl Harbor, of course, if I remember correctly. 2023 is the time. Okay, guys, so let's just look and see what's going on. Yesterday, we got a little bit of data in the morning. Now, we had the ADP number, which you will remember here is the private payroll number. That came in at 103,000, and the previous was also revised downwards a little bit, and the 103 was significantly lower, I think about 3.5 standard deviations lower than the market's expectation for that. So the point here is that the market got very excited and sort of thinking that this confirmed the narrative that the US labor market is getting looser and looser. Also, what was interesting is that the unit labor costs were down 1.2%, much lower than the 90 basis points expected, and a lot less than last time. So the point is here that the market is taking that as sort of indicating that, you know, indeed the US economy maybe is slowing down, that the labor market is loosening a little bit. And what's kind of interesting is that that had a very interesting reaction on the bond market. And let's just go into and see what happened. I'm just going to bring up the probability. So what I'm going to bring up here is the probabilities of cuts and everything. So we can see here that for the December meeting, obviously completely zero priced in of anything. But what we've been looking at is really the situation for the March meeting and the May meeting. And if we actually look at the March meeting, which is now 17 basis points of cuts priced in. So I just want to bring that up to the let's say a three-minute chart over the last 3 days. So quite a short-term one. And what you can see here is that when we got the numbers yesterday, which is the 6th of December, which is, you know, around about this time here, it didn't actually really change that much. So the point is that what I'm trying to say is that this is more cuts further low. And if anything, actually it sort of ticked up, not a lot, but maybe a basis point or two. So what's going on here is that the market is saying, okay, we've been dovish enough in terms of pricing for the Fed. There's no real need at this point, even with slightly soft data, to price in more aggressive cuts or a more aggressive cutting cycle by the Fed. On the other hand, what happened with the curve is that the market's saying, well, okay, you know, maybe the Fed is not going to sort of cut more aggressively, but definitely if the economy is slowing down, then that means that the future path of inflation is coming down with the unit labor costs and a loosening labor market. So the inflation expectations are going down. Inflation swaps are going down quite a lot. They went down yesterday by a few basis points. And also the overall future path of the economy is flattening. And so what that did, if we look at, let's say, something like the yield curve, we can see that like the 2s30s, that the yield curve is flattened quite aggressively. If we look at the 2s5s, we can see that's flattened quite a lot. And if we look at the 2s10s, we can see that's flattened quite a lot. And what that means is that the yields on the longer term, so the 10-year yield and the 30 are going down quite aggressively, basically on the idea of that the economy is slowing down. So it's interesting because what we've been having before is that with slightly weak data, that's been causing a bull steepening. So the front end yields are being sort of pushed down on the idea that the Fed is going to cut more quickly and more aggressively. But now it seems as though the market is kind of sort of happy more or less where that pricing is. And now it's sort of working on the back end of the curve. And basically anything which is considered a little bit sort of dovish in terms of the data is actually pulling down the yields on the back end, which of course is flattening the curve. So that's kind of the dynamic we have just from a trading perspective going to the non-farm payrolls. But of course, we have a bit more data this morning at 8:30. We have a little bit more labor data. Let's have a quick look at that. We've got the initial jobless claims. And again, that's expected to tick up just a tiny bit. Last time, 218,000 to 220,000. It's very, very important because, you know, people say, oh, it's ticking up, it's going up, it's going up. Yes, maybe slightly, very slowly, but the point is that from a historical perspective, the initial jobless claims is at a very, very low number. So let's see what happens today. Also, and a lot of people are talking about the continuing claims, 1.91 million. And then the narrative around that is that, okay, the initial jobless claims are still quite low, but if people are laid off and lose their job, then they're finding it a little harder and slower to actually find a new job. And that means the continuous claims is extending. So that's a little bit of evidence for the bears that the market, or at least the labor market, is kind of tightening, is loosening a little bit. So that's something to be looking out for. Other big moves overnight, kind of interesting. Just want to look, just while we're looking at the bonds here, is that this is a 3-minute chart here of the yield on the JGB. So on the 10-year Japanese bonds, and what you can see is that especially overnight, around about 11 p.m. or so our time, big spike up. So basically, though, over the last 24 hours or so, the yields on the Japanese bonds have gone up. They're now at about 76 basis points or so, and that's the highest they've been for a long time. And that was based on the comments that Ueda, the governor of the Bank of Japan, before a parliamentary presentation, he said something a little bit cryptic, that his job would be more difficult and complex at the end of the year. And in the context of the speech, he was talking about the fiscal year, which ends on March the 31st, which of course is also the time when all of the spring wage negotiations in Japan happen. And the idea is that for Ueda and the Bank of Japan, if the wages, the wage accords next spring, so next sort of March, April, if those wages go up, that will signal that inflation is sustainably on a higher level, which could cause him to sort of start tightening monetary policy. So that's just kind of a complex and convoluted way of saying that the yields are going up. There was a sort of a hintish interpretation, at least by the market, and you never quite know with the Japanese governors. But at this point, the market's taken that a little bit sort of hawkishly, that that's a way of sort of very subtly signaling to the market that the Bank of Japan and Ueda is looking to slowly exit from this incredibly loose policy. And you can actually see here, if we just look at a bit of the reaction here, you can see that in the yields, I've got the German 10 years subtracting the Japanese 10-year yield, and you can see that really pushing down here, and we're getting a divergence here. So this is quite interesting. We're getting a divergence that with the ECB, there's comments that the governing council seems to be relatively happy that cuts are coming. The market is priced in a pretty aggressive cutting cycle, I think about 125 basis points over the course of 2024. So we have this whole idea here that Europe is sort of slowing down, being dovish, going to cut, whereas the Bank of Japan on a sort of slightly opposite track, even if it's subtle, but there's a bit of divergence here. And you can see that divergence here expressed pretty clearly between the German 10-year yield and the Japanese 10-year yield. And you can see that the differential there is coming in pretty fast. Also, of course, if we just have a quick look at the US here, you see the US minus the Japanese one, that differential also is narrowing. And of course, that's having an outsized effect on the currency. So if we look at anything to the yen here, let's look at euro yen, absolutely having a big fall down, I think about 50 basis points or so. So euro yen falling. And the point is that could that go further? Quite possibly, although we have we have non-farm payrolls tomorrow, which will affect the dollar, which will affect the euro and everything. And then, of course, we have the ECB and the Fed next week. So, but what I would say, though, is if the euro JPY, let's say, comes back, pushes back to 157, 158, it could be an attractive short area. You'd probably want a little bit of a pullback. But it looks as though, going ahead on a 3 to 6 month time frame, there could be some divergence happening there. So also, just if we look at USD versus the yen, USD also falling a lot there. So at pretty key levels here as well, 145. If we get weak data this morning, but especially tomorrow, you've got to say that we could at least test another a fib level down, and maybe even get a bit further down. So it's going to be quite interesting days for the yen. Also on the cross pairs here, you can see, let's say, like the Aussie yen also falling. So the yen having basically a strong moment. Let's see if that continues. In terms of some other markets here, oil being absolutely crushed at the moment. Now, we had Putin in Saudi Arabia and other parts of the Middle East yesterday, agreeing to continue their cooperation. But basically, the bottom line here is that we had a big build in gasoline stocks in the US, which, although, I mean, to be honest, that's kind of, in terms of seasonality, is not unexpected. But this is really just a symbolic thing here. This is the OPEC attempt to sort of cut, well, that they apparently have cut voluntarily. The market was not at all interesting, and ever since then has been punishing the oil price. And a lot of this could be speculators, a lot of it could be sort of systematic selling. You know, the Saudi oil minister is always ranting on about that. But the reality is that the market is sniffing blood in the water and basically saying, every time the Saudi oil minister comes out, or Novak, the deputy PM from Russia, and says, oh, they could cut more, the market knows that they're getting to a point where they can't really cut that much more, and that it's a desperation move. It's absolutely a desperation move. So personally, I think oil, I mean, it might stabilize. It's hard now. The juice of this move has gone. I mean, it could come all the way down here. I mean, it could come down into the mid-60s, or it could sort of stabilize. But the point is that oil is weak. The time spreads are weak. If we look at, let's say, just even one of the time spread, the prompt spread, the CL1, CL2, so the two front ones. Where is it? I think I put it up here. Yeah, so this is just on a 30-minute chart going back, you know, about 10 days or so. And you can guys see here that, first of all, on the top here, we have the CL1 contract and the CL2. So the first and the second contract. And you can see that the outright prices, you know, obviously come down a lot. But not only that, you can see here that the market has flipped into contango. We're now, you know, trading at about 26 cents, which is quite a lot, actually. So that's signifying a very weak market. I just also had a look at the CL1, CL6, CL1, CL12, and then the December Z4 to Z5 now, which are all sort of metrics which the market looks at, and they're all trading in a sort of contango-like structure, which is signaling weakness. So the point is that the Saudis and the Russians have a problem. The Americans continue to pump a lot of shale oil, and you've got to say that probably, just in terms from a trading perspective, is this a buy the dip? I don't know that we're in at the dip here. I think at this point we would maybe want to see some kind of basing formation, because the market is skeptical. Even comments now, and some people talking about an emergency OPEC plus meeting. I think at this point, I mean, could this do this? It's possible, but I think whoops, let's just get rid of that. But I think also what could happen, I mean, it might sort of come down a little bit more here. And, you know, I mean, it could do this kind of thing. I don't know. Sorry, my ghost feed here is a bit weird. You know, you guys get the picture here. It's got to be a tricky one. I mean, maybe if you want to buy it here, just be aware that it could go down, you know, quite significantly, another $3 or $4. So you'd want to have some maybe medium-term sort of option structure there, just to deal with the volatility. But in terms of the futures here, I think you'd want to see more evidence of a basing formation. And of course, not the geopolitical, the global economic situation is a bit pessimistic at the moment. There's a lot of talk that, you know, China is slowing down, that Europe is slowing down, and America is about, or in, you know, sort of slowly slowing down, so to speak. And so from a demand perspective, there's not a lot of bullishness either. So I'm going to be leaving oil alone just for a little bit, and see what's happening there. So apart from that, guys, just in terms of the equities, equities a bit stuck in a little bit of a range here. It looks as though it's losing sort of energy. If we look at a couple of, let's say, just like the RSI or something like that, you can see that we're a bit overbought here. The market just coming off. The moving averages here, you see the MACD here on the daily, on the S&P, just starting to sort of roll over here a little bit. So for sure, it looks as though the market is a little bit fragile. On the other hand, you know, any kind of, I mean, really the big issue here is, you know, is weakening data. Are we still at the point where weak data is good because the Fed will hike less? Or cut more? But what I'm trying to say is that when we start to see sort of the moves like we saw in the bond yesterday, where we saw a bull flattening on weak data, that is indicating to me that the market, as I said at the beginning of the video, is sort of thinking that the Fed pricing for Fed dovishness is done. And so it just seems to me we have to be a bit careful. And we're looking today at initial jobless claims, but especially with the payroll data tomorrow. Are we getting to a point? We're also getting a couple of rejection candles here. Are we getting to a point on the S&P and maybe the NASDAQ as well, that bad news is starting to signal a recession, and we're starting to get that flip, that bad news is actually now considered bad for the stock market, just because the Fed pricing is sort of stabilized. And if that's the case, we're definitely already getting a bit of a rollover here, and that might be the case that we get a bit more of a significant pull pullback. Maybe not anything particularly horrible, but we could definitely get some kind of fib pullback, let's say, you know, to a 38%, you know, that would be a nice level here, 44.32 on the S&P, something like that. Okay, guys, I'll leave it there. As I say, initial claims, I'll probably put out a video later this afternoon, a little bit of a preview of the non-farm payrolls to see what's going on there. Okay, thank you very much and have a great day. Thank you.